What separates a good company from a great one? It's a question worth asking. It can present itself as a profound secret, a truly elaborate puzzle that is made up of countless moving parts, all working in a complex harmony. Some businesses are built to last successfully, operating for decades, but the vast majority of others will eventually fail and fade away into history. The challenge is learning how to consistently identify the real long-term winners before they capture the attention and imagination of everyone else. The timeless financial wisdom from one of history's greatest investors offers the profound and essential answers needed to secure your financial future. We're delving into the foundational principles for business and timeless investment wisdom from Warren Buffett's acclaimed collection of essays. We're going to explore the key concepts that define successful companies by breaking down powerful ideas like a durable competitive advantage. The business moat is a simple idea, famously used by Warren Buffett to describe a company's powerful and durable competitive advantage. A company's competitive moat is a defensive barrier that protects it from rivals, much like the deep moats that surrounded medieval castles of old. We're finally revealing the one big secret behind their long-term success. Get ready, because we are about to dive in and show you exactly how it works. Idea 1. Durable competitive advantage. A durable competitive advantage, or a moat, is a lasting edge a company has. It's a special quality that's difficult for rivals to replicate. Imagine a strong castle protected by a wide, deep moat. The moat is the defense. This visual metaphor explains the core concept perfectly. In business, this advantage acts just like that moat. It shields the company's profits by keeping determined competitors from getting too close. A strong brand is an incredibly powerful moat. Think of the worldwide love and trust so many people have for a simple drink like Coca-Cola. Another example is a patent. This is an official legal document that grants a company the exclusive right to make and sell a specific product. Business moats make it difficult for competitors to copy a successful product or service, thereby securing the company's strong market position. Companies with these durable advantages are highly attractive to investors. Their ability to consistently generate profits makes them reliable bets. Even when the economy is struggling or times are tough, these protected companies can continue to thrive and make money for their shareholders. Idea 2. Intrinsic value. Intrinsic value is the core of smart investing. It's finding an asset's real worth separate from the temporary distractions of its market price. Think of a company as a money-making machine whose intrinsic value is all the cash it will ever generate for you throughout its entire lifetime. We calculate its total lifetime cash flow from today until its final day, instead of just guessing its price for next week. The value of a business, like a simple fruit stand, is the total of all the profits you expect to make from selling fruit over its entire lifetime. Or it could be a giant factory whose value is determined by the future cash flow from all the products it will ever create and sell in its lifetime. That future income must be discounted to find its value today. $1 tomorrow is always going to be worth less than $1 in your hand right now. We add up all of a company's estimated future earnings and then discount that total to its present-day value. This is its true intrinsic worth. Buying below an asset's calculated value provides a margin of safety, and this is the true secret for achieving long-term investing success. Idea 3. Investor discipline. Investor discipline is staying the course when the market sends conflicting signals. It requires a firm hand, like a captain in a stormy sea. It's easy to get caught up in the soaring excitement or sudden panic. Discipline means ignoring the constant market noise and emotional chatter. When stocks soar, the fear of missing out creates a powerful urge to chase them. Discipline is resisting that popular, but often foolish impulse. When markets drop, a powerful herd mentality triggers panic selling. It takes real courage to ignore the stampede and trust your own thorough research. Discipline requires sticking to a well-thought-out investment strategy. This plan, made with a clear head, is your anchor in turbulent times. This discipline is built on a foundation of homework, meaning you must truly understand the fundamentals of the businesses you choose to invest in. It's about buying these well-understood businesses at a fair price. You wait patiently for an opportunity rather than paying for popular hype. The principle is simple: buy a sound business and hold on for the long term. True investing is measured in years or decades, never just by the quarter. This disciplined method helps you ignore the market's daily chaos and focus on building steady long-term growth with your investments. Idea 4. Long-term investing. Warren Buffett champions long-term investing, a core philosophy, can happily take advantage of his foolishness and find a bargain. Don't let market noise dictate your decisions. Focus on the true value of the business, not on Mr. Market's daily and often irrational drama. Idea 6. Corporate governance. Corporate governance is the system that directs and controls a company. It's the blueprint for how decisions are made and power is balanced. Warren Buffett emphasizes this system is vital for long-term success. Good governance acts as the sturdy roots for sustainable corporate growth. The board of directors is the cornerstone of this system. They play a critical role in providing oversight and guiding the company's future. Their primary duty is to hold management accountable for its actions. This ensures the company stays on the right path for everyone involved. Buffett insists directors must be shareholder-oriented. Their decisions should always prioritize the interests of the company's true owners. A deep understanding of business is non-negotiable. This business savvy allows directors to make informed, strategic, and effective choices. Adopting an owner's mindset means treating every dollar like your own, fostering deep financial prudence and a genuine commitment to creating value. Finally, a genuine interest in the company is essential. This passion drives them to go beyond the boardroom to truly understand the business. Idea 7. Investing versus speculation. Investing and speculation can seem alike on the surface, but they're fundamentally different approaches to building wealth in the financial markets. Investing is like owning a piece of a business where you buy shares because you truly believe in that company's successful and promising long-term future. You've checked its profits and leadership, and you think it will grow. You are investing based on the asset's own expected future performance. Think of speculation as a high-stakes bet on short-term market trends, trying to predict the next big move for a quick financial gain. With speculation, you don't really care about the company behind the stock. You only care about predicting the direction of the stock price. While an investor analyzes an asset's actual earning potential, a speculator simply tries to guess how other people are going to value that asset. An investor focuses on the long-term performance and intrinsic value of a business, much like a patient farmer carefully tending to his growing orchard. The success of a speculator is very similar to a gambler at a casino. It's all about making the right guess for the next roll of the dice. Idea 8. Reputation and integrity. For Warren Buffett, reputation is not just an ethical ideal, but a core component of a company's long-term success and sustainability. A brand's integrity and moral principles are fundamental to building genuine trust with its customers, suppliers, and valued employees. Buffett highlights that a good reputation is an extremely fragile asset, as it often takes decades of diligent hard work and effort to carefully build. But all of that incredible hard work can be completely undone in a few moments. Just one single wrong move and everything can come crashing down. The fallout from a shattered reputation is swift and devastating. Trust is instantly destroyed, and the company's very survival is called into question. Losing a good reputation is like dropping your most powerful shield, leaving your entire business vulnerable and exposed to a world of unseen dangers. That's why integrity should be a non-negotiable value. It must serve as the true foundation for all of your decisions and every one of your actions. A leader's most vital duty is safeguarding this priceless asset, as it is the very foundation upon which all lasting value is truly built. Idea 9. Circle of competence. This concept describes the boundaries within which an individual can claim to have true expert knowledge. Think of all your knowledge as a vast area, and your circle of competence is what you genuinely understand with profound and absolute clarity. The key to smart investing is simple: only buy companies inside your circle of competence, the ones you can understand through and through. It's not about the size of your circle. What is critically important is knowing the boundaries and having the discipline to stay within them. If you know the car business, then you have a genuine advantage. Use that unique insight to analyze both manufacturers and their dealerships. Avoid investing in what you don't understand, like biotech. Investing outside your knowledge isn't true. Investing it is simply pure speculation. You don't need to be an expert on everything. You just need to evaluate the few things you know and act decisively when an opportunity arises. Therefore, work to define your circle. Once defined, the discipline to operate exclusively within it becomes your greatest investment strength. Idea 10. Accounting practices. Warren Buffett champions clear, truthful accounting, so financials can accurately picture a company's health, helping investors make well-informed decisions. Proper accounting is the language of business. It must reflect economic reality, not be used to obscure the truth or manipulate for short-term gains. Imagine a financial report as a window into a company. Honest accounting makes that window crystal clear, while bad accounting completely fogs it up. With a clear view, an investor can confidently assess the true value. Obscured numbers lead to poor decisions and are essentially financial traps. Buffett specifically criticizes how stock options are handled. He argues they are a clear form of compensation and must be recorded as a real expense. When companies don't expense stock options, they are not being honest. It's a method used to artificially inflate their reported earnings to mislead. This common distortion creates a false image of profitability, hiding the business's true earning power behind misleading accounting. Honest accounting protects investors by ensuring the language of business speaks truthfully, revealing a company's genuine financial foundation. Idea 11. Margin of safety. A core tenet of value investing is the margin of safety. You buy a stock for a price significantly below your estimation of its intrinsic value. Imagine building a bridge that can handle £30,000, but the heaviest truck that will ever use it only weighs £10,000. Intrinsic value represents a company's genuine worth, determined by analyzing its current assets, earnings, and its future growth potential. This price-to-value gap is a protective cushion shielding your investment from the stock market's wild and unpredictable swings. This buffer accounts for normal human error, so you have a margin of safety even if your initial calculation isn't quite right. It also safeguards you against bad luck or unforeseen negative events. A company might face unexpected challenges that reduce its future value. When you insist on this discount, you're not just buying a business, you're buying it with an incredibly powerful layer of built-in protection. This discipline minimizes downside risk significantly. It is the bedrock of preserving capital while seeking substantial long-term returns. Idea 12. Diversification. Warren Buffett's view on diversification challenges common wisdom, advising a more focused portfolio for investors who truly understand their holdings. Common financial advice says to spread your money across many different investments to minimize risk, a strategy known as the many baskets approach. Buffett warns that over-diversifying can be a harmful mistake. He argues that being too unfocused is what ultimately leads to mediocre returns. Over-diversifying your portfolio means your most brilliant insights get lost in a sea of average investments and their potential is wasted. His philosophy is to concentrate investments in the few key opportunities you understand deeply and have the highest possible conviction in. A truly focused strategy gives your best ideas the necessary space to flourish, yielding far better results than a scattered portfolio. This isn't about taking blind risks, but about mitigating them through a deep understanding of a few carefully selected businesses. Warren Buffett's philosophy is to concentrate your investments into just a few baskets and then watch over them with unwavering care and attention.